Ladies and gentlemen, good day and welcome to the Asian Energy Service Limited Q4 FY26 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. From the management, we have with us today Mr. Kapil Garg, Managing Director, Mr. Sumit Maheshwari, Group Chief Financial Officer, and Mr. Nirav Talati, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kapil Garg, Managing Director, Asian Energy Service Limited. Thank you, and over to you, sir.
Thank you. Good evening, everyone. I welcome you all to the Q4 and FY26 earnings conference call. Along with me, we have on the call Mr. Aman Garg, Director at Asian Energy, Mr. Sumit Maheshwari, Group CFO, and Mr. Nirav Talati, the CFO for Asian Energy, and our Adfactors PR, our Investor Relations Advisor. I will begin with some perspective on the operating environment and our strategic positioning before our Group CFO walks you through the numbers in detail. FY26 has been a momentous year for Asian Energy, a year in which we transformed from a domestic energy services player to an integrated international energy platform. And the next 12 to 24 months represent an extraordinary opportunity for our group. The single biggest macro development for our industry has been the West Asia conflict. Rising geopolitical uncertainties around the Strait of Hormuz have created near-term volatilities, but it has also reshaped the global energy investment cycle in ways that strengthen our outlook going ahead. For India, with crude import dependence of nearly 85 to 90% and gas import dependence of around 50%, energy security has become an increasingly critical national priority. This quest for energy security applies not only to crude oil and natural gas, but also to mineral security, ranging from coal to critical minerals, which I will brief you on later. All of this is accelerating the push towards domestic exploration and production, supported by structural reforms to improve the attractiveness of private sector participation. After nearly a decade of constrained upstream capital expenditure globally from 2016, the industry is witnessing a sharp reversal in investment trends at elevated crude prices. India has committed nearly 100 billion of investment into oil and gas sector by 2030. Similarly, other nations of global oil majors and NOCs are accelerating their capex programs and investments across the value chain. Much of that capital will be deployed through service providers like us. At the same time, higher energy prices have made that marginal fields more attractive and profitable than ever. Policy tailwinds in India, evident in the form of HELP, OALP, DSF bid rounds, as well as the recently announced royalty rationalizations, are unlocking acreage at a pace unseen before. We have already submitted bids for 3 contracts under the Discovered Small Field Round 4, and we expect this pipeline to translate into multi-year revenue visibility. For Asian, the increasing industry shift towards integrated field development continues to create a significant long-term opportunity. The success of the integrated field development models demonstrated in projects such as with Vedanta is expected to accelerate the adoption of integrated field development contract across E&P players. We are primed to take up opportunities for these large integrated multi-year contracts because our post-merger of SAR along with Kuiper will make us the only listed energy services company in India that will be capable of self-delivering across the value chain. At the operational level, the planned production ramp-up at Indora and Mewal fields, targeting approximately 1,000 barrels of oil equivalent per day by FY27, along with a plan to ramp it up further in coming years, is expected to directly benefit from stronger crude realizations, thereby supporting higher revenue and EBITDA per barrel. In spite of tailwinds, we remain disciplined on capex deployment and timing. For Kuiper Group, we believe that the acceleration in capex by global oil majors and NOCs will translate into stronger manpower and technical staffing demand across key markets. At the same time, elevated crude prices are reviving offshore EPIC and deepwater project activity, resulting in broader increase in hiring requirements across the upstream value chain. Kuiper's presence across countries, combined with over 2 decades of established relationship with top-tier EPCI and drilling clients, along with a strong specialized talent network for long-tenure master services agreements, positions the business advantageously in an increasingly tight manpower market. This acquisition is aligned with our long-term vision to expand our integrated operation and maintenance capabilities, diversify our service offering, and scale our global presence. On the strategic front, we are pleased to share that the company has received approval from SEBI for the proposed merger with Oilmax Energy, and the NCLT convened shareholders meeting is now scheduled for June 2026. We expect the completion of the merger process by September-October 2026. With respect to Oilmax's assets, we are commencing production for Tupik field in the coming months, where pipeline connectivity is expected soon. We will also increase production from Hamguri field in this year once connection with Numaligarh refinery and the national grid is established, which is expected over the next few months. We also expect production to start from Dwarmara field in this year. Work has already commenced in the CBM block after receiving necessary permissions. Our integrated oil and services segment delivered a steady performance, supported by strong execution. Meanwhile, the mineral segment continued to be a key growth driver for the company. In the mineral infrastructure space, we are already lowest bidder in one of the tenders and expect to secure a few more contracts in this vertical going forward. As I said earlier, energy security will be strengthened not only through domestic oil and gas production, but higher mineral production too, and the government policy is recognizing and encouraging this more than ever. This applies not only to coal but also other critical minerals as well, where India is expected to see a higher domestic investment in the foreseeable future to reduce import dependencies. In the coal space, we first saw the thrust on first mile connectivity, and we capitalized on it at the most opportune time. The capabilities we have developed in the mineral infrastructure space in areas like bulk material handling and movement, paired with our expertise in oil and natural gas, will allow us to capture the current tailwinds in the mineral space in the form of coal gasification projects, the critical mining projects which are being auctioned by the government. Heavy investments are expected in these allied sectors such as bulk material handling, logistics, processing of raw ores, which will lead to significant addressable opportunities for Asian Energy, and our unique strength will make us well poised to capitalize on them too. Before I conclude, I would like to emphasize the large structural shifts that have come from the additions of Kuiper and our integrated field development contracts have fundamentally de-risked our earnings profile from seasonal and sensitive earning cycles towards multi-year recurring revenue stream of engagements with predictable cash flows, which are diversified across the plethora of clientele, climates, and geographies. This is going to result in more predictable and higher quality quarterly performances and earnings and visible cash flow conversions. Nevertheless, considering the impact of West Asia and the ongoing conflict on our path ahead, in both good ways and bad ways, we continue to keep a close eye on any and all developments in this conflict, which could impact our operations directly or indirectly. In recognition of the company's strategic developments and strong operational performance during FY26, we are pleased to propose a dividend of rupees 1.25 per share, subject to shareholders' approval. This reflects our continued commitment towards creating shareholder value while maintaining adequate financial flexibility to support our long-term growth initiatives. I would like to extend my sincere gratitude to our board of directors, our employees, and our partners for their continuous support and dedication. Now I hand over the call to Mr. Sumit Maheshwari, our Group CFO, to talk about the financials.
Thank you, Kapil sir. Good evening, everyone. Talking about FY26 financial performance, the company reported revenue from operations of rupees 791 crores compared to rupees 465 crores in FY25, reflecting a growth of 70% year-on-year. EBITDA for the year stood at rupees 99 crore, representing a growth of 37%, while EBITDA margin came in at 12.5%. On a profitability front, adjusted profit after tax for FY26 stood at rupees 60.6 crores compared to rupees 42.2 crores in FY25, translating into adjusted PAT margin of 7.7%. It is important to note that FY26 PAT figure is after adjusting one-time exceptional item of rupees 9 crore related to Kuiper acquisition cost and a write-off. Moving to Q4 FY26, the company reported revenue from operation of rupees 338 crore compared to rupees 215 crore in Q4 FY25, growing 57%. EBITDA for the quarter grew at 47% to INR 49 crores compared to rupees 34 crores in corresponding period last year, while EBITDA margin came in at 14.6%. During the fourth quarter, we witnessed certain challenges and disruption related to the supply chain owing to West Asia conflict and some delays from client side, which has delayed execution and consequent revenue recognition in Q4. As a result, the company was unable to fully meet the previously communicated guidance for the year. However, we would like to clarify that this is largely a timing-related impact rather than a loss of revenue, and the deferred revenue are expected to recognize in FY27 over the coming quarters as the operating environment normalizes and execution schedule stabilizes. Despite these temporary disruptions, our diversified business model, strong execution capabilities, and integrated operating platform enabled us to deliver resilient performance during the period. Within the oil and gas segment, revenue for Q4 26 stood at rupees 256 crore with a segment profit of rupees 42 crore. For the full year basis, segmented reported revenue 633 crore with a profit of 102 crore. In the mineral segment, revenue for Q4 FY26 was 82 crore rupees with a profit of rupees 18 crore. For the FY26, this segment reported revenue of 158 crore while profit came at rupees 32 crore. As we step into FY27, we do so with a robust, well-diversified order book of approximately rupees 1750 crore. This is excluding taxes and excluding the Kuiper portfolio. This combined with the deferred revenue from FY26 gives us a strong and improved revenue visibility heading into the new year. We continue to remain a net zero debt company with a strong balance sheet, and the recent receipt of rupees 92 crore from warrants conversion has further strengthened our balance sheet. We are well capitalized, operationally focused, and strategically positioned to accelerate our growth in FY27. Our priorities are clear: tighter execution, deeper Kuiper integration, and sustained margin improvement. We remain committed to delivering long-term value for all our stakeholders. We now open the floor for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Charchit Malu from Genuity Capital. Please go ahead.
Hi sir, thanks a lot for the opportunity. First of all, congratulations on good set of numbers. So my first question is regarding the oil mix. So what was the revenue of oil mix in FY26 and what kind of revenue we can expect going forward in F27 and F28?
Regarding the oil max revenue, the FY26 oil max revenue is on the similar line on FY25. Regarding the going forward oil max revenue, we have already guided that in FY29, FY30, we are looking for reaching an oil max revenue of between 800 to 900 crore rupees where the current existing producing assets and the assets which are coming into the production in this year will start contributing to our revenue. It's difficult to give an exact guidance for FY27 and FY28 because a couple of our fields are coming into the production in this year. But on the long-term visibility point of view, FY29 and FY30, we are looking at the revenue guidance of roughly around 800 to 900 crore rupees coming from Oil Max.
So like we are saying in FY26, the revenue was close to 128 CR, right?
It's almost similar to FY25 revenue.
So close to 130 CR with 35% PAT margin, right?
The Oil Max, we have granted some ESOPs for the last year before the merger announcement. So the PAT margins and those numbers may not be the comparable with the FY25, but yes, on the revenue side and with the operating EBITDA side, the performance of Oil Max is almost similar to what we had in FY25.
Great, sir. Great. Sir, just one more question. We are on still line with our guidance of Asian Energy, right? That is 30% YOY growth.
Yeah. So as we told you, FY26 we had a Kuiper only for the 7 months. For the standalone basis for FY27, we hope to grow between 30 to 40%. And the Kuiper for the full year basis, we are looking at the top line of roughly around $60 to 65 million. This is what we are guiding for the FY27.
Okay. And what kind of blended EBITDA margin and PAT margin we can, expect in F27 and F28?
On the standalone basis, our EBITDA margin for the last year, FY26 was roughly around 16%. And we hope to improve our EBITDA margins at least by 100 to 200 bps in FY27. On the Kuiper front, our EBITDA margins were 7% last year, and we hope to there also we are hoping to increase our EBITDA margins by 100 to 200 bps.
And on the Concall level, sir?
On the Concall level, I think our EBITDA margins will be roughly around 12 to 13%.
Great, sir. Thank you. Thanks a lot.
Thank you. Next question is from the line of Vaibhav Barjatia from Honesty and Integrity Investments. Please go ahead.
Hi sir. Thanks for providing the opportunity. So, continuing the discussion on Oil Max from the previous participant, so I understand that by 29-30 peak revenue 800, 900 crores. But drilling more onto it, the largest asset that Oil Max have in terms of peak production is Duarmara. And Duarmara, I just wanted to have an update from you because that is critical to achieve those objectives. I think the production was supposed to start sometime last year and it is getting delayed for a few times. So if you can just highlight what are the reasons for the delay and is there natural gas flow that has happened or there is a water cut on the well or it is now being converted to oil production story. What is happening currently on Duarmara? If you can provide details over this, that would be helpful.
So in Duarmara, as you are aware, we are non-operator. The field is operated by Antelope Ceylon.
Right.
So the information we have got from them that the well was drilled last year, as you correctly pointed out. And on the log, we have found good oil shows and gas shows. And during the testing period, oil was flowed to the surface along with gas. It appeared to be a little bit tighter. So Antelope is doing a little bit more tests as we speak today. And today morning also there was some more oil flow in the well. So detailed testing is being carried out now with a workover rig and we'll provide a further update to you.
Got it.
As we get information from Antelope.
Okay. When is the production likely to start? When the oil or gas, when the commercial sale likely to start?
I think within a month or so we'll be able to give you much better prediction as the testing results come out. It's difficult for me to commit to a date to you today. So we will follow up more with our partner and both of us will come out with the tentative dates.
Got it. Understand. Yeah, that's it from my side. Thank you.
Thank you. Before we move to the next question, a reminder to the participants to ask a question, you may press star and one. Next question is from the line of Santosh from Funveda. Please go ahead.
Hello, sir. Thank you for the opportunity, and congratulations for the great set of numbers that you have provided. I have a couple of questions. One is with respect to, again, Oil Max Energy and AESL capabilities with respect to gasification, because recently government has released their interest in coal gasification. So do we have any capabilities, or are we planning to build any capabilities in that respect?
So on the gasification side, I mean, we do, as you are aware, we do build process plants for oil and gas. So we do understand the basic chemistry and the process plants. But if you ask for a specific, do we have the knowledge? We don't. So we are evaluating in the evaluation stage right now, and we will look for a technology partner. We're already in discussion with some potential partners, and hopefully we'll finalize it in case we decide to go forward with this. But all the coal gas, I meant in my speech earlier, that even large-scale coal gasification plants will require coal handling element of it. And we are definitely looking to provide that service.
Okay, got it. Thank you, sir. And my second question is regarding the coal handling plant itself. Are we, due to this crisis in Middle East and raw material price increase across segments, are we seeing any challenges in our coal handling plants, equipment, or any other risk that you're facing from raw material side of you?
On the coal handling plant side, we are not facing any challenge because almost all the material is domestic supplied. We are not really facing any challenge on the coal handling plant side.
Okay, and one last question, sir, regarding the Kuiper process. As I believe, if I'm not wrong, it is in UAE. So, because of the recent geopolitical tensions, is this process face any challenges, the Kuiper side of the entity?
So we did see some disruptions in March during the month only in Qatar. In Qatar, we are providing services offshore. So that was one geographical location we faced some challenge. But most of those clients have kind of remobilized now, and we are almost back to normal now.
And adding to what Kapil sir has told, Kuiper has a diversified portfolio and diversified locations also. So apart from the Middle East, Kuiper is active into Southeast Asia and other African market also. So yes, as we mentioned, there was a small disruption in Qatar in the March month, but most of the operations of the Kuiper have remained unaffected during this period. And we have seen, once the things are getting normalized, we have seen the remobilization started in the Qatar also. So if the situation remain secure and safe, we do see a higher opportunity and the Kuiper operation returning back to the normal.
So if I understand right now, there is some impact in the Middle East portion of the Kuiper, but not to large extent. Is that correct?
Yes, that's right.
Thank you, sir. I have a few more questions, but I'll come back in the queue.
Thank you. Next question is from the line of Atul Taka from Taka Securities. Please go ahead.
Hi, sir. I have just two questions for you. First one is, beyond Keeper and Olimax, does management see any further inorganic opportunities in the O&M services or mining services? If yes, what would be the acquisition criteria?
I mean, obviously we remain open to inorganic acquisition opportunities, but if specifically are we chasing something right now, the answer is no. And as we keep on talking about the capital discipline, even the opportunities, if and when they come along, we will evaluate them very carefully before making the decision.
Got it. And secondly, sir, what is the expected consolidated capex requirement for FY27 and FY28, and how much of this will be towards upstream assets, field development, and international services expansion?
Regarding the capex commitment for FY27, so there is no capex commitment we have for our services business or for international expansion. The only CapEx as an Asian what we are looking at currently is drilling more wells in our Indore and Mewar field, where we have found good oil success. So there we are evaluating to drill additional wells. So the overall commitment what we are seeing in over the next 1 year on the overall block level is roughly around 100 crore. And out of that, our portion will be roughly around 50 crore. Apart from that, there is no additional CapEx which we are currently planned or which we have committed. And regarding the oil max assets, the couple of oil max assets which are already producing, there we will be doing the capacity ramp up where we do not require any further CapEx, and couple of our blocks where our partners are carrying out the CapEx. So as such, there is no committed CapEx or large CapEx commitment from the oil max side also. And depends on the success what we get into our endeavor, we will continue to keep evaluating the CapEx requirement, and we'll remain very, very disciplined in our overall CapEx assessment.
Fair enough. Fair enough. Got it. Thank you so much, and all the best for you.
Thank you.
Thank you. Next question is from the line of Sunny Gosar from MK Ventures. Please go ahead.
Yeah, thanks for taking my question. My first question is regards our guidance for the standalone business. So we have guided for about 30 to 40% top line growth for FY27. So what I wanted to understand is how much of this top line growth can be achieved only based on the current order book that we already have in hand of about 1750 crores, and how much are we dependent on some new orders coming in during the year to kind of achieve this guidance?
Sunny, to answer your question, so our current order book is 1750 CR, and as we told you, we are already L1 in one of the tender where we are expecting the contract award. So the guidance which we have provided is more or less almost 90-95% of the current guidance what we are providing is coming from our existing order book and the contract where we are L1. So we have not factored in any new contracts or new order book built up into our current year guidance.
Got it. That's very helpful. And in terms of the overall order pipeline and outlook for say maybe FY28 and beyond, so what is the visibility there in terms of oil and gas, minerals business? So how should we think about say a 2-3 year perspective on growth in the service part of the business, which is the standalone business, and how are we seeing new discussions or opportunities there?
So Sunny, as I mentioned earlier in my speech, we are on this integrated development basis we are looking at. There are multiple opportunities on the radar. So based on the Vedanta model which we have kind of successfully proved, ONGC has recently come out with some tenders which we are evaluating for decent sized fields to provide end-to-end solutions. And I believe some other operators are also considering the same model. So on the oil and gas front, I do see visibility of multiple tenders coming out for integrated service platform. On the coal handling and the material handling plant, also there are multiple opportunities on the radar as we expand more from coal to other minerals. So we do see a decent pipeline to keep us going for the next few years for the targeted growth rate.
Got it. And is it fair to assume that the growth rate, or maybe if you can give us some like a 2 to 3 year view on how should we think about overall CAGR growth rate for the standalone business beyond FY27?
25 to 30% would be a pretty decent range, Sunny.
Got it. My next question is on Kuiper. So in the presentation, you have mentioned that you look to scale the business to about $100 million of revenue by FY29. So that largely is at between say 900-950 crores of top line by FY29 versus current annualized run rate of between 530 to 540 crores. So how should we think about drivers for achieving this growth? Is it new customers? Is it new geographies or enhancing wallet share with existing customers. So if you can help us understand what would be the drivers of this growth over the next 2 to 3 years?
It is a combination of all the factors you talked about, and let me elaborate. Right now, the major chunk of the top line comes from providing manpower for drilling rigs. We have already started to diversify the base, and we are in multiple discussions, and we have started seeing some initial success with large EPC contractors in Middle East and Southeast Asia. So we have started to diversify our portfolio of clients and services. So rather than being dependent on only offshore drilling rigs, we are already expanding into marine services, into offshore construction services, into cable laying, and we also intend to diversify geography. For example, in Africa, we have limited presence right now, but we are evaluating that market very carefully with the intention of diversifying there. So combination of all the three factors you talked about.
Got it. And at about $100 million of top line, what kind of EBITDA margins can be achieved with operating leverage and efficiency? So from current 7% margins, what could be the target margins by FY29?
We are targeting 11 to 12%.
Okay, got it. And one last question before I get back in the queue. So in last year, I think in the AGM presentation, you had indicated some FY29 guidance of top line, EBITDA and PAT. Based on the current circumstances and whatever opportunities you are seeing, are we kind of on track to be able to achieve those numbers, or any change in the broader guidance? I think you had indicated about 450 to 500 crores of PAT by FY29. So any color on that?
We are more or less on the same guidance still, Sunny. I mean, as I mentioned earlier, there is a turmoil in the world, but with the plan we have and the opportunities we have on hand, there is no reason for us to believe that there is any change in that guidance.
Got it. Thank you for the detailed answers, and I'll get back in the queue.
Thank you.
Thank you. Next question is from the line of Hina Parekh from Sovereign Capital. Please go ahead.
Hi, thank you for the opportunity. Firstly, congratulations on good set of numbers. I have two questions. First is on what is the status of Mewar production ramp up, and what are the key operational steps to reach the 1000 BOPD target by FY29? And also additionally, what is the expected consolidated capex and working capital requirement over the next 2 years, and how will it be funded as well?
So first question, how we will ramp up Mewar. We have already drilled 2 new wells, and both wells have performed better than the initial expectations, which has further confirmed our belief in the development of Mewar and Indore field. So we are mobilizing a rig now, and within a month we'll start drilling back-to-back wells. The initial plan is to drill 6 more new wells, and we are already producing in excess of 200 barrels. And with the new 6 wells coming in, we should start getting closer to the target. It's an iterative process, oil and gas. So as we drill more and more wells, we keep on refeeding the data into our system to keep on fine-tuning the well locations. But with the initial success we have seen, we are very confident that the guidance we have provided will be able to meet.
And specifically the 1000 BOPD guidance we want to achieve in this year, and in the next coming years we intend to take Indore production further to 1500 BOPD per day in next 2-3 years, depends on what type of results and success we get into the current guidance. Now in terms of your second question about the requirement of the working capital and other things, so as you would appreciate, we continue to remain zero debt company, and our debt to equity ratio is virtually nil. So we have a sufficient room to raise working capital debt and additional debt also, which require us to fuel our growth. We have been supported by two nationalized bank and two private sector bank also, including the City Bank. So they are supporting us in whatever manner is required to get additional banking guarantee limits or additional working capital limit. So we remain confident that we will have a sufficient working capital limits available to us to pursue our future growth also. And we remain very well decently capitalized.
Got it. Thank you so much and all the very best.
Thank you.
Thank you. Next question is from the line of Nimesh Pandya from NP Invest. Please go ahead.
Hello, sir. Am I audible?
Yes.
Yes, please go ahead.
Yes, sir. Thanks for giving me this opportunity. So I have a couple of questions. First being, what are the main geography-wise growth opportunities for Cooper across the Middle East, Africa, and Southeast Asia? And are there any new countries or client segments being targeted in FY27?
So Kuiper, if you ask specific geographies, I mean, Nigeria is one geography we are seriously considering because the several current clients of Kuiper are operating there and they keep on requesting us to look at that. So as a specific country, Nigeria is definitely on the radar. But we are seeing a lot of activity in Southeast Asia too, which is our current market. So between Southeast Asia, Middle East and Africa, especially focusing on Nigeria, are the current target markets.
Okay, got it, sir. So next question means, how is the management prioritizing capital allocation across organic growth capex like Mewat field development, Kuiper expansion, oil max integration, debt reduction, and shareholders return?
So I think Sumit explained earlier about we don't really have a very large capex program going forward this year, and most of our businesses in the service side do not require capex. They only require operating expenses, which we are kind of fully funded.
Okay, got it. Thanks, sir. That answers my question.
Thank you.
Thank you.
Thank you. Next question is from the line of Karina Kaur from Starcom Capital. Please go ahead.
Hi, thank you so much. Firstly, congratulations on such great numbers. My question is, could you provide details on the integration roadmap for Oilmax post-merger? Additionally, what will be the governance framework and business segment disclosures in place post the merger?
So, regarding the Oilmax integration, as you would appreciate, Oilmax and Asian, the reason for integration is to build an integrated organization platform and integrated energy platform. So the integration activities are already underway. In fact, Asian provides services to Oilmax at a couple of the blocks which have been operated by Oilmax, and one oil block is common between Asian and Oilmax. So integration is already under the way, and we expect integration to be over by the time we receive the complete merger approvals and all other aspects. In terms of the governance, we already very highly governed company, and we put a very good focus on the corporate governance. So after the Oilmax is being merged into Asian Energy, the entire promoter and all business of the promoter will be into the single entity. Currently also the promoter owns Asian Energy directly through Oilmax, and then the entire businesses will be into a single entity, which is a large listed entity. And we already have a strong corporate governance system and independent directors on the board, and whatever additional things are required to make our corporate governance system more robust, we will implement those things.
From the reporting question you asked, we'll be reporting in 3 segments. One is the oil field ownership model, which is current Oilmax model. Second is the Asian current services model, and third is the global Kuiper model. So those are the 3 segments we'll continue to report.
All right. Thank you so much. Good luck.
Thank you.
Thank you. Next question is from the line of Santosh from Funveda. Please go ahead.
Hi. One quick question regarding the Mewat field. Right, as we are producing around 100 BOPD crude in the field, how does the current Brent link pricing works or the current environment of the pricing impact these cash flows? Like how does exactly the pricing works for the crude that we generate or produce from Mewad?
So our crude from Mewad, we have a contract with Indian Oil Corporation, and the formula is linked to Brent, the monthly average of dated Brent. So as per the formula, we supply to IOC and we get paid.
Okay, so in that sense, the higher the price, the better the revenue from that particular field for us.
That is correct.
Okay. And regarding the minerals thing that you have spoken before, right? I did not completely get it. So can you spread more light on that, sir, with respect to like the critical minerals? Are you seeing any developments there from the government side or from the tenders or anything going on in that field?
Yes, so if you have seen, the government is awarding a lot of critical minerals blocks, and the award process and that process is continuously happening. And now, after the receipt of a lot of critical minerals blocks award, the work has started happening on those blocks. And when we need to appreciate any bulk material, whether it's a critical mineral or coal or any natural resources, they require specialized logistic solution and bulk material handling system. So the opportunity what we are eyeing into that segment is more of setting up the logistic chains and the bulk material handling system there. And specifically in the critical mineral where the ore processing or critical mineral processing is required, the logistics required at the two places. The first thing is bringing the ore to the processing plant and then taking back the entire ore which has not been used back to the dump yard. So the logistic chain, specifically the bulk material handling systems, become very, very critical aspect for the critical mineral also. So we are targeting that particular segment, and with the few mines which have been awarded likely to come into the operation in coming years. So we do see good opportunity coming from there. And the second segment which we like to target in the critical mineral segment is the processing and setting up a processing plant or running those processing plants like what we have been doing into oil and gas segment.
Okay. This is very insightful. Thank you very much.
Thank you. Ladies and gentlemen, we'll take this as the last question for the day. I now hand the conference over to the management for the closing comments.
So thank you all for joining the call. I hope we were able to answer most of your questions. If there any particular question remains unanswered, kindly reach out to our ad factors and we'll be happy to clarify. Thank you so much.
Thank you, sir. On behalf of Asian Energy Service Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.